Hello everyone, and welcome to our channel, TutorDollar. In this video, we're here to provide you with valuable information and insights. Whether you're a student, a professional, or simply someone who wants to expand their knowledge, we're here to help. So sit back, relax, and let's dive in. The goal of the firm. It's important for business owners to figure out the right goal for management decisions. Should trying to keep costs as low as possible be the goal? Or to increase sales or share of the market? Or to keep growing and making money? Let's take a closer look at this important question. What should management try to do the most of? Let's say you own and run a pizza place. You can set any goal you want for your business, depending on what you like and how risky you are willing to be. You might be afraid of going bankrupt and losing money, for example. To keep from going bankrupt, you could try to keep your costs as low as possible by paying low wages, not borrowing money, advertising as little as possible, and not growing your business. In short, you won't do anything that makes your business more risky. You will sleep well at night, but if your profits are low, you may not be able to eat well. On the other hand, you could try to get as much of the market as possible and become the biggest pizza business in town. Your plan could be to lower prices to boost sales, borrow a lot to open new pizza shops, spend a lot of money on advertising, and come up with unusual menu items like pizza de foie gras. In the short term, your high-risk, high-growth strategy will make it hard for you to eat well and sleep well as you push the company to its limits. You will either get very rich or go broke in the long run. There must be a better goal for operations than either of these. Why not make the most money? Profit maximization is a goal that seems like a good way to make decisions. After all, don't business owners and stockholders want their businesses to make money? Maximizing profits seems like a good goal for a business, but it has some serious problems. One problem with maximizing profits is that it is hard to define profit. To the average business person, profits are just income minus costs. To an accountant, on the other hand, a decision that makes more money according to one set of accounting rules can make less money according to another set. A second problem is that accounting profits and cash flows are not always the same thing. For example, many businesses count their income when they make a sale, which is usually before they get the cash payment for the sale. In the end, the owners of a business want cash because only cash can be used to buy goods and services or make investments. The value of cash flows depends on when they come in. $1 today is worth more than $1 tomorrow because you can invest it and earn interest on it today. Cash flows can be worth a lot of money for a business, and getting money one day late can cost a lot. For example, if a bank has $100 billion in outstanding consumer loans and the average annual interest payment is 5%, it would cost the bank $13.7 million if every customer decided to make an interest payment one day later. Another problem with profit maximization as a goal is that it doesn't care if you get $1 today or sometime in the future. Cash flows are very important in finance. For example, the longer you don't pay off your credit card balance, you have to pay more interest to the bank for using the money. The interest builds up because of the time value of money. The longer you have access to money, the more you have to pay for it. One of the most important ideas in finance is the time value of money. Lastly, profit maximization doesn't take into account the risk or uncertainty that comes with cash flows. There is a trade-off between expected return and risk. This is one of the most important ideas in finance. Most people choose the less risky investment when they have a choice between two investments with the same expected return but different risks. This makes sense, since most people don't like taking risks and need to be paid for doing so. The goal of making as much money as possible doesn't account for differences in value caused by differences in risk. The value of cash flows is affected by how risky they are. $1 that is risky is worth less than $1 that is safe. The reason for this is that investors don't like taking risks and need to be paid for doing so. For example, if the expected return on two investments is the same, say 5%, most people will choose the investment with less risk. As a result, the cash flows of an investment are worth less the riskier it is. In the end, it seems that profit maximization is not a good goal for a business because it is hard to define and doesn't take into account the cash flows of the business. We need a goal that looks at a company's cash flows and takes into account both when they come in and how risky they are. The market value of the firm's stock is a good way to figure this out. Make the firm's stock worth as much as possible. Any asset's real value is based on the cash flows that can be expected from it in the future. This is true whether we are buying a certificate of deposit from a bank, a bond from a company, or an office building. Also, when security analysts and Wall Street investors decide how much a company's stock is worth, they look at 1. The size of the expected cash flows, 2. When the cash flows will happen, and 3. How risky the cash flows are. Notice that the way stock prices are calculated gets around all of the cash flow problems we brought up when we talked about profit maximization as a goal. So, maximizing the value of the firm's stock at the moment is a good goal for management. For a company whose stock is traded on a public market, maximizing the value of its stock is a clear goal that is easy to measure. We just look online at the stock's market value on a given day to find out how much the stockholders' shares are worth, and whether the price went up or down. Publicly traded securities are perfect for this job because they trade near their true value on public markets, which are wholesale markets with a lot of buyers and sellers. What about private corporations and partnerships, whose stocks are not traded on the stock market? The value of the owner's equity is equal to the total value of the stockholders' or partners' interests in the business. So, we can restate our goal for these companies as follows: maximize the value of the owner's equity at the moment. The only other rule is that the entities must be businesses that make money. The goal of the financial manager is to get the firm's stock to be worth as much as possible. The goal of financial managers is to make decisions that bring the stock price of the company up as much as possible. By maximizing the stock price, management will help stockholders get as much money as possible. To do this, managers have to make decisions about investments and financing so that the total value of cash inflows is as much higher than the total value of cash outflows as possible, benefits at costs. Pay attention to the fact that the goal is to maximize the value of cash flows, not profits. It's important to realize that maximizing the value of stock and maximizing the value of claims to the firm's other stakeholders are not mutually exclusive. In order to make the stock's value as high as possible, managers must make decisions that take into account the needs of everyone involved. Take the case of a company whose managers decide to hold off on paying suppliers in order to give the company's owners more cash. Suppliers are likely to be against this delay, and they might raise the prices they charge the company to make up for the cost of this policy to them. In the worst case, suppliers might stop selling the company their goods. In its 2019 annual report, IBM says, "Our business model is built to deliver long-term value to stakeholders." This is a good way to sum up the idea that companies need to consider the interests of their stakeholders. In order to increase the value of the owner's equity as much as possible, managers must make decisions that take into account the needs of everyone involved. Diversity, equity, and inclusion (DEI) programs in companies are an example of initiatives that focus on an important group of stakeholders, the employees, with the goal of maximizing stockholder value. DEI programs try to bring people of different ages, genders, religions, and other backgrounds into the workplace and include them in the decision-making process throughout the organization. Several studies show that diversity helps both financial performance and innovation, which is good for the bottom line of a company. For example, a recent report by McKinsey & Company said, companies in the top quartile for ethnic or cultural diversity on executive teams were 33% more likely to have industry-leading profitability. In the last 10 years, financial managers have also paid more and more attention to the firm's environmental, social, and governance strategies. These factors, which are often called ESG, have caught the attention of both customers and investors, which suggests that they have a big impact on the value of a company's stock. Even though the idea of ESG is quite broad, many people connect it to issues of sustainability and corporate social responsibility when judging how a company's operations affect the community as a whole. In 2019, the Business Roundtable, which is made up of the CEOs of nearly 200 of the largest U.S. companies, put out a statement with a new definition of the purpose of a corporation. In this statement, the CEOs emphasized that the main goals of business are to invest in employees, give customers value, deal with suppliers in an honest way, and help communities outside of the business. In response to the needs of both consumers and investors, public companies often report on their ESG activities in a clear way, and a number of investment advisors rate the quality of corporate ESG strategies. Can decisions made by management affect the price of stocks? One important question is whether or not the stock price is really affected by what the management does. The answer is yes, which is good news. As we've already said, a basic rule of finance is that an asset's value is based on how much cash it is expected to bring in over time. Figure 1 shows that a company's management makes a lot of choices that affect its cash flows. Management decides, for example, what kinds of products or services to make and what kinds of productive assets to buy. Managers also decide how much debt and equity financing the company uses, how it will collect debt, and how it will pay its suppliers, to name a few things. Cash flows are also affected by how well management makes products, how good the products are, how well management sells and markets them, and how much the company invests in R&D for new products. Some of these decisions have long-term effects on cash flows, like the choice to build a new plant. Other decisions, like starting an advertising campaign, have short-term effects on cash flows. For example, on November 9, 2020, Pfizer said that its experimental COVID-19 vaccine worked well in a trial. On the day of the announcement, the stock price of Pfizer went up by almost 10%, which showed that people thought the vaccine would be good for the company's long-term cash flows. The managers of the company also have to deal with a number of outside factors that they have little or no control over, such as the economy, whether it's in a recession or growing, war or peace, and new rules from the government. External factors are always changing, so management has to figure out how these changes will affect their strategy and decisions and make changes as needed. The main point here is that over time, management makes a series of decisions when putting the company's strategy into action. These decisions affect the company's cash flows and, in turn, the price of its stock. Firms that have a better business strategy, are more flexible, make better business decisions, and can carry out their plans well will have a higher stock price than similar firms that just can't get it right. Figure 1, the most important things that affect stock prices. The stock price of a company is affected by many things, and management can only change some of them. Managers don't have much control over external conditions, blue boxes, like the state of the economy in general, but they can keep a close eye on these conditions and change their strategy as needed. Managers also make a lot of other decisions that have a direct effect on the expected cash flows, green boxes, of the company and, by extension, the price of the company's stock. And that's a wrap for today's video. We hope you found it informative and helpful. If you did, don't forget to like, comment, and subscribe for more great content. And if you have any questions or comments, feel free to leave them below.